Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John. How are you doing?
Sam, I'm doing fantastically. It also seems as though the market's doing a little bit better.
It has been a reprieve, a sigh of relief. I think there's a lot of terms you can use.
Well, the thing is, it has been a little bit of a reprieve here the last several days. However, there's still a lot of unanswered questions as far as I'm concerned, and there's still a lot of potential for volatility that I'm scared that people might get a little bit lulled to sleep, if you will, with this little bit of reprieve, a little bit of green ink, and that's because where the rubber meets the road, what's changed?
Well, not a lot when we don't even know what necessarily was being implemented in the first place. So it's kind of hard to say what's changed when
Indeed.
you don't know what started.
Yeah.
But I think that's the main point of, markets are difficult and they're always pricing in unknowns and probabilities of unknowns. But it feels like right now it's that, we got that first shock move down, right? The tariffs were way worse than I think clearly the market expected. We expected, most people expected. It got real ugly really quickly. I mean, one of the quicker drawdowns in history.
Yes.
And then, we got to this point where it's like, okay, we're maybe backing off of them a little bit. Then maybe we're talking about some trade deals, but maybe they take a few years to actually implement. There's a lot of these maybes going around, and really it depends on who is actually has the microphone that day. And so I think when you zoom back out, not a lot has changed, right? So that's what's made this, it feels a little weird, and that for a lot of people psychologically it's felt like, okay, we're past that, right? Oh, that was ugly. Well, good thing we're onward and upward now. Well, we talked about it yesterday and things haven't changed.
Well, the thing is, it is very frustrating for me. It's frustrating, I would imagine, for a lot of people that do what we do for a living, because when the seas seem to be a little bit calmer, you have people ask you, is it now a good buying opportunity? Now is a good buying opportunity? And the quick answer, or I guess maybe the unpopular answer is every day is a good buying opportunity if your time horizon is 10 to 15, 20 years.
Yeah.
If you treat investing as a marathon as opposed to a sprint, go ahead and buy now. Don't look at your investment portfolio. In 10 to 20 years, you'll have more money and then be done with it. However, that's not fun. That's not sexy, if you will. And people want to know, is now the best buying opportunity, and we're to squeeze an extra 2, 3, 4, 5 percentage points out of the markets. And, I got to tell you, I'm not sure, because I've never seen anything like this. I've been doing this a long period of time. I've got white hair, as you well know. You're looking at me right now. You see, I've got white hair. Been in this industry 34 years. And I've never seen an American president just throw around economic policy the way that the president has this month. And if I've never seen it before, how can I react to it? Because I have no historical precedents off of which to make my decisions.
Yeah, the unknown of it tends to, we talked about this. I tend to say you want to go back to what your plan was before this happened, because when you're planning and investing, you're planning for unknowns,
yeah,
right?
That's right.
So we're still in unknowns. That has not changed.
Yeah.
The price of securities has changed, but we still have all these unknowns. So again, maybe that's not the sexiest answer, but it kind of leans back to what was the plan before Liberation Day, Obliteration Day,
whatever you want to call it. And that is a very good point. It's what do you think was going to happen previously? I mean, what was your risk tolerance beforehand?
Yeah.
What was your expectation for return? It's during periods of market volatility like this, you will have people that will freak out, say, take me out of the markets, and then say, I went back into the markets, when instead they just need to take a deep breath and go, can I sleep at night with this? And if you can't sleep at night with this, you're taking too much risk long term.
Yeah.
If you want to jump back into the market every time that the president sends out a social media post or says something on the television that the market's like, that good for you. However, that actually makes me a little bit more nervous this week. Although the market has made money this week, I'm almost as nervous about what has transgressed this week as I was during Liberation Day. And the reason for it is nothing's changed. The president comes off the hip on Monday, starts bashing Jay Powell. Market's down, 1,000 points?
Calls him the big loser.
Yeah, calls him the big loser. Market's down over 1,000 points. My goodness, we're going to fire Jay Powell. Holy smoke, devil's come to dinner. Next day, president said, take it back.
Take it back. He went a step further. He said, I never planned on firing.
Yeah, I know it's never going to do that. Market's back up 1,000 points. And maybe there's a deal with China. Maybe there's not.
Yeah.
And all that. It's just like
they had discussions. Who's they? Well, don't worry about it.
All this type of stuff. It's vague, and it seems as though we're conducting economic policy on social media, as I might have already said, and that's no way to run a railroad. Let alone try to invest your money, because who knows what happens tomorrow? Is the president going to come out and say something, about blowing up Xi Jinping, or defending Taiwan tooth and nail? I mean, we just don't know what he's going to have to say, and right now it doesn't seem as though he really cares.
Yeah, this has always been, when people talk about technicals in markets, that's always been my flaw with that, is that
it's a great backwards looking tool, by the way.
Yeah, it is. And I think there is some it's psychological aspect to it, and I think there is validity to it at times, but I think the times that it works the least is times when there's so much human decision taking hold of the market, right?
Yes.
Because right now, exactly to your point, it could be Trump fire. We could reach a technical low that should be a Bible, and then the next day Trump blasts something out and the market's down 2,000 points or up. So it takes the market's weighing, psychological weighing as a whole, out of the equation when one person can drive.
Well, it assumes some measure of rationality. It assumes some measure of historical performance being indicative of future results. This is the way we did in the past. This is where support levels were. This is where everyone caught their second win. This all that type of stuff. And so when people are saying it's a good buying opportunity, they're the same people taking a look and going, okay, here's where resistance was, or here's where support was for the markets. A better way to play it. Here's where support was, and that was all assuming that we've got a rational market right now. Well, I would say it's anything but rational.
Yeah.
When again, people are responding significantly and severely to comments that the president throws about.
Yeah.
I mean, it's just, I've said this time and time again, I wrote about in Common Sense, I have historically always believed that politicians get too much credit for the good and too much blame for the bad. Right now, I can blame the president for everything that's going on with the market this week, and even pretty much for the month of April.
And it's what's interesting is we're getting into earnings season, right? Or really, we're in.
Well, companies aren't. You saw today, U.S. Airlines aren't giving any guidance.
Well, that's what I was getting at. Is we're in the early-ish innings still of earnings season. We've had a few big ones, and guidance is either pulled or it's wider or weaker. I mean, it's.
Yeah.
We've had a few that have come out with stronger guidance, but it's a good opportunity to say we don't know, right? If your industry is impacted at all, we don't know, right?
Yeah.
What's it going to be in 3 months, 6 months, 9 months? And so we have not even had the market yet, really, for the most part, maybe on the individual name level, but focusing on what's happening with earnings, which is really the core root of where stock prices should be going.
Yes.
So
you're absolutely right, because we're focusing on the president's comments as opposed to the overall profitability of corporate America. And anyone that thinks that what's happening with the markets and what's happening with economic policy and all the threats out there, if they think that that's not going to detrimentally impact consumer confidence, one, and business confidence, two, I want a sip of whatever it is they're drinking.
Yeah.
Because there is absolutely no way this doesn't have a depressing impact on long-term decisions.
Well, I think it also can have a very rapid short-term impact. I mean, we've seen some trucking companies already decide to close shop. The trucking rates have plummeted to levels that were that are now lower than COVID levels. So, I mean, we're seeing a real impact on the economy already. We've seen a real impact in the GDP, and I get the net exports has been a big driver of that. But, we add on, we still have these things on the horizon that were a little concerning. Those are there, if not worse. We're starting to pick, student loans are having to be repaid now for the first time in years. How's that going to help consumer confidence, consumer spending? Earnings have come in a little bit softer, I'd say, on the whole. They've come down a little bit.
It hasn't been the worst case scenario, but it's not.
But so we have these things that we were concerned about before those aren't getting better, right? If anything,
And they
those,
certainly aren't going to get better with tariffs being thrown about willy-nilly.
right. So these are, they're not separate issues, but they're kind of being viewed as separate issues. It's like, hey, let's get through the tariffs, and then we can worry about the other stuff down the road. But the problem with that is the tariffs have real impact on these concerns that are down the road.
Well, if anything, I mean, you sit there and take a look at the consumer confidence readings, and today we will get, it's either today or tomorrow, we'll get the last iteration of the University of Michigan consumer sentiment for the month of April, and it's off significantly. I mean, a lot since where it was right after the election. I mean, it is down a lot. It's down a lot since March. And the reason being is obviously uncertainty about tariffs and what prices or how much things are going to cost moving forward.
Yeah.
And so we have seen, from what I can tell, maybe a little bit of an uptick in consumer expenditures in March and April as people are buying what they can now. Well, under the
Pulling
assumption
forward.
pulling forward under the assumption they're not going, it's going to be significantly more expensive in May and June. So I would assume we're going to see some really weird-looking economic data. April's not going to be as bad as originally feared, but May could get real ugly in terms of the official data, and June could as well.
And you got to remember that container ships take a month plus. Close to a month to some ports, over a month to get to other ports from China.
Yeah, and so
I mean, some of these things.
So what happens? All that stuff that's ordered now and is not on the water by the time any tariffs are resumed.
Yeah.
Well, that's a
or
real
pulled
problem.
off, or
it's a real problem. And so that is why I'm not so certain I can sit there and tell anyone with a straight face that while this week does feel a little bit better, certainly, than the week immediately following Liberation Day, and it certainly does feel a lot better than it did on Monday of this week, I still can't with any confidence tell you, say, the volatility's over, Sam. It's safe to go ahead and plow your money back into the market. I can't tell anyone that. As a matter of fact, I would tell people, listen, in 5 years' time, you're not going to be too upset. One, if you waited a couple of weeks, or two, if you went ahead and bought.
Yeah.
But if you're looking for returns over the next 3 months, I wish I could give you a stronger answer.
Volatility has this psychological grasp on people, and you and me included. Like I know you're probably the same way. When the market is up, it's hard not to feel a little better. I get scared at times, seeing some of the swings and the 10% up day on the pause and all that. But who's going to feel worse about when the market goes up, right? You're going to feel better, and you're going to have at least a little bit of you that's saying.
I'm seeing emerging market type swings here. It's crazy.
Well, we are. We've talked about briefly in some previous episodes, but we talked about the emerging markets movements in the broader markets, not just stock markets. The dollar weakening, dollars weakening, and the yields going up. That is an emerging market movement right there. Stocks being down, 20% as rapidly as they were, and then up 10% in a day. That's something you'd see in Southeast Asia or Latin American countries and emerging markets as a whole, really.
Yeah.
All three of those, especially
Global South,
especially when they're combined. Those movements, when they're all combined together, is not something you see from the global reserve currency.
No, it's you don't like to see that. The backup in bond rates this month, the decline in the dollar, gold prices, all that stuff bespeaks of a lot of the market, a lot of uncertainty that's still out there, and that means to me that I'm not sure if now is a great time to go back in. Again, longer term, yeah, it always is. There's never a good time to buy. Let's just get that. There's never a great. There's always going to be a lower day. There's always going to be a higher day. There's never a great time to buy. So if you have a disciplined approach to how to invest your money, times like this, you shouldn't change what you're doing.
Yeah.
Investing is a marathon and not a sprint. All that good stuff. Please don't consider this an offer to buy or sell investment securities or services of any kind. I'm just saying what's the prudent thing to do. And so when telling clients right now, we're going, I don't know if now's a good buying opportunity, but I do know that what we agreed upon, I still think this is the best course of action.
Yeah, because we, again, I kind of said this, but the plans were for people, or should be, would be, are put in place for unknowns.
Yes.
We are in unknowns. So that means it's almost like, it should be working out exactly like we think it should, right? Obviously, you hope markets go up, but you make these plans for the almost guarantee that at times markets are going to pull back. A 10% plus pullback happens on average every other year. A 20% every few years more than that. These are part of what happens in the market.
Yeah, I mean, how could I argue with that? Because you're absolutely right. So, moving forward, what does the remainder of this year entail for us? There's still a lot of unknowns. Don't know what the president's going to say next. Don't know what we're going to do with the tariffs. We all knew that they were out there. Did not envision that the reciprocal tariffs would be as great as they were, and that we'd get into a war of words with the Chinese the way that we have, the world's two largest economies, yelling at each other. That was not what I anticipated at the beginning of the year, truthfully. But at the beginning of the year, I did anticipate, and you anticipated, we all anticipated, our investment committee anticipated, the first 2 quarters of the year were going to be slightly slower than what the last 3 quarters of last year was. That's an easy bet, frankly. I mean, so 2004 was surprisingly strong in a lot of ways. What did I say?
2004.
Yeah, 2020.
2004 was, I think, pretty strong too.
Fair enough, smart guy. But 2024 was much stronger than what any of us thought it was going to be. So it's just low hanging fruit to say we're going to be a little bit softer in the first half of the year. Federal Reserve will likely start be a little bit more aggressive cutting rates than what the futures market was thinking, and we closed the end of the year with a lot of wind in our sails, and we enter 2026 in much better shape, and I still think that's probably the case.
Yeah.
I still think that's the case.
This is not a doom and gloom.
It's not a doom and gloom,
even though it may have sounded like it.
Yeah, but it's not doom and gloom, assuming that we get back to some sense of normalcy, and the president doesn't try to upend the global economy with talk of reciprocal tariffs and banning. I mean, for all intents and purposes, banning trade with the Chinese.
Yeah, and well, look, a lot of how we look at the markets are, what are the headwinds, what are the tailwinds, and what are the probabilities of those, and the best and worst cases of those coming to fruition. Yeah,
I mean, and the thing is, I hope whatever the president is envisioning in his head with tariffs, I hope some of it happens. I'm not sure exactly what it's going to be, but I just want to get it past us.
Yeah.
And the best, and that's the best potential for significant economic activity this year and for strong market returns. And you know something, Sam? Regardless, I don't think it's going to lead to a sudden surge in manufacturing employment in the United States.
No, and the market rallied off the election, right? I mean, pretty significantly.
Well, the market rallied off the election not in hopes of a tariff and trade wars. It rallied in the expectations of something completely opposite.
Right. So the real reason, you may just say exuberance and what have you, but it's this
lower taxes
rates,
and lower regulation.
Less regulation, lower taxes. Pretty simple.
Period.
That's it. It's great for corporate earnings. Tax cuts are immediate impact on the bottom line.
Immediate.
If we can forecast what that's going to look like, if we even have somewhere close to what the tax rates are going to be.
For every increase in, for every
just
dollar
based
increase.
On margins and.
Well, I mean, it's the way the multiplier works. For every increase, $1 increase in earnings per share,
$20.
Create $20 of wealth.
Yeah.
So, I mean, why wouldn't investors like that?
Yeah.
Instead, we don't have the extension of the 2017 tax cuts, and we don't have any new tax cuts that I'm aware of. I haven't seen any regulations being chopped terribly much. But what we have is the potential tariffs, which would be very expensive for the U.S. economy.
Yeah.
It's understandable. It's understandable why investors aren't real happy.
So the goal is to, I think, for all investors, no matter whether you like the administration or not, is to move past this to where we can start focusing on these other things, right? So we've talked about some consumer weakness, some the lower class. We've talked about all this in the past. Okay, well, let's start getting to policies that can help these people and help consumer spending, lower tax rates. Incentives, whether it's to have kids or what have you. I mean, all these incentives that are talked about and money being thrown around, if we can continue to support the lower class and middle class and the overall consumer, that's what will get the market excited.
Without a doubt. And I've loved the way you're thinking. Well, guys, thank you all so much for listening. We always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we got to say or how we think, you can go online to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find access to all kinds of exciting information, including links to previous Trading Perspectives podcasts, links to our newsletter, weekly newsletter, or slash blog, Common Sense, and links to our quarterly magazine and analysis, which is out now. It's called Macro and Market, first quarter of 2025. It's good stuff with some forward projections for the remainder of the year. As always, we also do have some quality pieces from other Oakhurst associates, including Mac Frazier, who heads up our advisory services group. With that being said, Sam, give you one last chance to say something exciting about this exciting topic.
That's all I've got.
That's all I've got today, too. Y'all take care.